Good day and welcome to the DoubleLine Total Return Webcast. Today's conference is being recorded. At this time, I would like to turn the conference over to President of DoubleLine, Ron Riddell. Please go ahead.
Well, thank you and good afternoon and welcome to the DoubleLine Webcast with Jeffrey Gundlach and Andrew Sue. Title of today's webcast, Peace, Love, and Understanding. Please mark your calendars for some of the upcoming webcasts. On October 10th, we have a diversified fixed income webcast where we'll cover some of our fixed income asset allocation funds led by Mr. Jeffrey Sherman, our Deputy CIO. And then Mr. Gundlach and Mr. Sue will be back up on December 5th to talk about our total return bond fund again. If you'd like to see the rest of the 2023 webcast schedule, you can go to doubleline.com. And if you would like to receive a copy of today's presentation slides in the webcast player, you can click on Request Webcast Content on that tab. You can follow us at our Twitter handle, DLine Funds, and we do have a couple of YouTube pages, DoubleLine Funds and DoubleLine Capital. To gain access to some of our thought leadership here at DoubleLine, we do have two podcasts, the Sherman Show podcast, which is led by Jeffrey Sherman and Sam Lau, and Monday Morning Minutes with Sam Lau and Jeff Mayberry, where they feature weekly macro and market recaps. You also have access to DoubleLine's Channel 11 with our portfolio manager, Ken Shinoda, and a new channel with our product specialist team called PS Perspectives. All four of these audio and video outlets, you can gain access to that at doubleline.com. I want to highlight today we'll be discussing the DoubleLine Total Return Bond Fund. And here you can see the different expense ratio and minimums. We have three share classes, an institutional, iShare class, retail, N-share, and our retirement class, the R6. Standardized performance on the Total Return Bond Fund. The fund was launched 4/6 of 2010 through the end of August this year. The annualized return on the fund is 3.63%. versus the Bloomberg U.S. Ag Bond Index at 2.16%, and annualized outperformance of 1.47%. And also, you can see the iShare SEC yield, the net number, at 5.63%. So with that, without further delay, I'll turn the webcast over to Mr. Jeffrey Gundlach.
Back to school webcast on the Total Return Bond Fund. Already heading towards year end. It's hard to believe. I feel like I say that every year. So this is entitled Peace, Love, and Understanding. It's a song written by Nick Lowe, but made very much more famous by Elvis Costello, who covered it on one of his third album, I think it was. And the lyrics are really apropos to kind of the mood that we have these days societally. I'll just read a couple of stanzas. As I walk through this wicked world, searching for light in the darkness of insanity, I ask myself, is all hope lost? Is there only pain and hatred and misery? And as I walk through troubled times, my spirit gets so downhearted sometimes. So where are the strong and who are the trusted? And where is the harmony, sweet harmony? What's so funny about peace, love, truth, peace, love, and understanding? And it was a big hit, and it's a very raucous song, much more hard-charging than the one Nick Lowe himself recorded a few years earlier. Rolling Stone magazine hit it just right, saying that the song is delivered with a sincerity bordering on desperation. So let's get started. We've got this presentation divided into three sections. The first one is understanding, and we just have a few slides in the section, but I want to sort of paint the picture of where we've been and where we're headed with regards to government activity. So here's the federal budget deficit as a percentage of GDP. And you'll notice that it got really bad in the lockdown, understandably, but then recovered all the way back inside of 5%, only to now deteriorate another, 3 or 4 percentage points, percent of GDP or so. So really, the economic growth that we're experiencing with U.S. GDP in the recent several quarters is really just budget deficit. If you didn't have the budget deficit increasing from 3.5% or so to 7.5% or so, you wouldn't have any GDP growth. That's the delta there. So you can see that we're at such a terrible level in what's supposed to be a recovery or a good economy. We're almost down to the same percentage of GDP as the global financial crisis. And here's the interest rates in context of the Federal Reserve. And you can see that the brown line on the left-hand side, that's the current tightening cycle. And this isn't even updated. This doesn't even include the most recent hike in July. So we see that the Fed funds rates now is up at about 5.25 to 5.5. And you can see that the degree of tightening is longer, more than any going back to 1987. I think the 1997 one is missing here. I'm not sure why, but the other ones are all there. And so it's happened to a great magnitude and and at a pace which hasn't been seen before. So the green line was 2004 tightening going into the global financial crisis, and this is faster and even higher. Now, of course, with these interest rates going up, we're facing a really big challenge that I'm sure the Fed is aware of and thinking of, but I think all investors should think about too, and that is the growing interest burden. We had so many bonds that were issued 2, 3, 4, 5 years ago where interest rates were at zero on the Fed funds rate, and we had 1% yielding treasuries broadly. But now we can see that with the Fed raising rates above 5% on short-term interest rates, we see an explosion of interest costs, which is obviously not going to stop as long as time passes, which is a guarantee, and as long as the Fed funds rate stays where it is or perhaps even goes higher. I'm not sure it's going to go higher, but the Fed, I think, is open to that idea. But we see that the interest expense has now gone from $500 billion or so a couple of years ago to now $900 billion, and it's grown up to 3.2% of annual GDP. So this is a real tractor pull. The more time that passes, the higher these bond yields stay, we're going to get accumulation of an incredible amount of interest expense. And we can see it's already bigger than the defense budget, which of course has grown in the past 5 years as well, just not as fast as the growth of interest costs. So not only has the government suffering with all this higher interest expense, but obviously businesses are as well. So look at what's happened to interest rates paid on average on short-term loans for small businesses. They typically are about 3 to 4% above the Fed funds rate. And so not surprisingly, the Fed funds rate has gone up by 500 basis points plus the cost of these loans has gone up by about 500 basis points. And now money is not cheap at all anymore. So all of the misallocation, if you want to call it that, of investment resources that was put in place at the zero interest rates is now really starting to be suffering some very high pain. This will, of course, lead to increased defaults as time goes by. And should interest rates stay at these levels or go higher, the problem just gets that much worse. And so finally, here's something that's interesting. This is the outlays each year in blue, and we got the tax receipts in yellow. And you'll notice that the blue is always above the yellow. And then we got these tremendous distortions with the lockdowns and the reopenings. We see that in 2020, we had a shortfall of $2.3 trillion, and then $1.7 trillion in 2021. And then not much of a shortfall in 2022. But look what's happened this time. Why is the gap getting so much bigger? Well, in part, it's because tax receipts were delayed. Here in California, we still haven't paid our 2022 income taxes, which are due October 15th. So one thing that has been pressuring the bond market has been the lack of tax receipts leading to this higher deficit. That will in part go away, thankfully, because taxes will be paid. But I'm wondering about the economic consequences of taxes being paid, both in October, in the case of California taxpayers, and then again in April, if they don't change the rules again, we'll have, in a 6-month time window, we'll have 2 years of taxes paid. And that could be negative for the economy. I think people adjust their lifestyles. When you don't have to pay your student loan, or if you don't have to pay your taxes, and it goes on for a sufficient length of time, I think people adjust their habits. And so when people weren't paying their student loans, I think they took out other types of debt. So they're used to paying a certain amount of interest. They don't owe it to their student loan. Maybe they take it out on a credit card instead, and we'll see that in a little while. But this could be a positive for the bond market because at least we won't have so much net supply as we've been suffering with this year. So we will have less supply of bonds, and perhaps there'll be a negative economic consequence of the retiming of these tax payments that could lead to the potential for a bond rally as we get in the next 6-month time window. So that's the understanding of what's going on the very big picture. And now we'll move to the section that's entitled Peace. Doing the inflation section, peace might be an overstatement for what's going on with inflation, but at least it has gotten better. We see the CPI, which was up at 9.1%, the red line, a few quarters ago, and we see it's dropped down to 3.7, although it has hooked back up, which we anticipated. We think we're going to stay at the 3.5 to 4 level for the next 6 months or so, maybe 4 months or so, at least through year end. And then we expect that inflation might go down back to a 2 handle. It's going to be dependent upon energy prices, which have gotten a little bit out of control again, with West Texas Intermediate above 90 for the first time in about a year. So oil prices have been going up. We saw that reflected in the PPI energy component today with a high number on the PPI, although the PPI still on a year-over-year basis remains well contained. We'll see that in a moment. Core CPI, less food and energy at 4.3. That continues to come down. Obviously, it's less volatile than the headline CPI. So here's what's causing these inflation readings on the CPI. It's all the blue bar is basically the whole inflation rate, and that's services, excluding food and energy. So it's service inflation, wage inflation that are really the sticky parts of the puzzle. We can see energy until probably the last few weeks. Energy was actually a negative in the CPI in the last 6 months or so. And we see that there's really no inflation in goods anymore. And even food inflation has calmed down, although it does remain positive. Here's the shelter component of the CPI, and we have an interesting indicator here because we see the S&P CoreLogic Case-Shiller Home Price Index is the blue line, and it tends to lead the CPI shelter component. And here we have the lead being 15 months is the best fit. And with that 15-month lead, what this suggests is we might see the shelter component of the CPI go to 0 potentially. It certainly looks like it's going to go down in the months ahead. So at least this part of the puzzle doesn't look all that frightening. We all know that the shelter component of the CPI is a lagging indicator. It's not real time. This CoreLogic is much more real time. And so it leads by about 15 months. So there's some reason for hope on that section of the CPI. In fact, another reason to believe that, this is corroborated by the Zillow Rent Index. And here we have a 12-month lead from the Zillow Rent Index to the US CPI Owner's Equivalent Rent component, which is most of the shelter component. And it shows a similar picture that we should expect inflation to pretty much go all the way back down to where it was on the shelter component prior to the pandemic. That's where the red line was at about right-hand scale, about 3, and now it's back at 3.3, and looks like it's still heading lower. So some relief coming on the CPI. Let's look at some alternative measures of rent. We've got our apartment list and Zillow, both run series of rent rolls, and we can see that they both are the same, roughly, that the apartment list rents are now basically at 0 year over year, slightly negative, in fact, and the Zillow rents are back down below 5%. So there's a little bit of peace here in these readings. Now, the PPI came out today, and we see that the headline number of final demand jumped up. It was at 0 a couple of months ago, and it jumped up to 1.6 year over year. And then we have excluding food and energy, which is a little bit less volatile. PPI, the core number, isn't so different from the headline as you see in the CPI. But we can see that the core CPI is really down to 2, the core PPI rather, is down to 2.2, and the headline at 1.6, that's pretty much in line with the Fed's 2% target. So it's not really all that scary at the present moment. Export and import prices are some of my favorites because these are not adjusted seasonally and they're not adjusted for hedonics. Those are the real prices. And we see that the export prices got up above 17% year over year a few quarters ago, and the import prices got up to about 13%, and they've plummeted down to now negative numbers. So it's negative 4.4 on the import price index and negative 7.9 on the export price index. So deflation in export and import prices, interesting, is I'm sort of wonder why people are so concerned about inflation. Here's the PCE, another measure of inflation. This is the one that needs to have some improvement for the Fed to really, I think, fully stop raising interest rates, because we see the red line, which is the headline PCE, got up to 7%. It's fallen all the way to 3.3, which doesn't sound that scary. But then we have the core index, and that's the one that is problematic. It just hasn't come down very much. It's still above 4. I think the Fed needs this core PCE to go down to 3.5 or lower to think about really putting the end to the interest rate increases once and for all. More good news, their PCE inflation dispersion, what percentage of the share of the items in the PCE of having price increases? Well, it was darn near 100% a year and a half ago. And then the lighter blue is the fraction that have price declines. And obviously that was near zero around a year and a half ago. And that's changed by about 50 percentage points relativistically. The increases is down to about 70 and the decreases down to about 30. So it's about 40-point differential now, when before it was about 95-point differential. So that's looking a little bit better. And then we have the one that is really the problem, because Jay Powell went out a little over a year ago and declared that his new favorite inflation measure is super core PCE, which means the PCE core less housing. So we're getting down to a small basket of things that people actually spend money on, because we're leaving out food, energy, and housing, which seems like most of people's lives. But there's the blue line, the super core PCE, and it has not improved at all in the last 2 years. And this is really the issue for the Fed. They need this super core PCE blue line to head down, certainly below 4, and it's at 4.7 right now. I would think it would need to go down to 3.5 or below, just like the core PCE. And that is not happening at all. In fact, it's at a local high. It looks like it's actually about as high as it's been any time in the past year. And so that's the one that really has to have movement. That's the one people should be looking for, the most real-time signals as to what the Fed might be apt to do. The bond market, though, sees absolutely no inflation problem at all. We can look at the break-evens based upon the relationship of nominal treasury bonds and the inflation-protected securities. And we can say that there's just no inflation other than 2.2 to 2.3, whether you're looking at a 2-year view, a 5-year view, a 10-year view, or even a 30-year view. So the bond market seems, on its pricing of nominal bonds to TIPS, seems pretty happy with the actions the Fed has taken and the style in which they've done it, because there's just no movement here at all. Bloomberg Commodity Index, let's check in on some other prices. Not much going on here. We've been living around the 200-day moving average, the dotted red line, for a while now, although we are peaking above it. We are above it today, but not by much. We're at 107, and the moving average is around 106, just rounding there. So it looks like commodities using on this chart, it'll be interesting to see if they can clear their 200-day moving average. Right now, it's been pretty much sideways, except for the most recent move in oil, which has been pretty substantial. And that could be a catalyst for a commodity breakout. I've been negative on commodities really since the second quarter of 2022, or neutral on commodities. I'm starting to get a little bit more bullish on commodities, although the potential for an upcoming recession, which we're going to look in, makes commodity timing more short-term oriented than longer-term oriented. Here's gold, which I always get asked about. Gold is just so range-bound. It got up to 2,000, maybe 2080 or so at the high, retested it again in 2022, retested almost again in the middle of 2023, but can't really seem to break out. It kind of looks like a triple top. At 1911 on gold, we're sort of in no man's land. I would really want to see gold prove itself by also, just like the commodity index broadly, moving above the dotted red line definitively, which is the 200-day moving average. And gold itself is right on its 200-day moving average, pretty much a little below today, but we'll call it on top of. So gold for me, I'm sort of neutral on gold. Here's the dollar long-term view going back to 1998. And it's been kind of a volatile year to date with a little bit of upside now on a year-to-date basis. The dollar went up to 115 when the euro got down to parity pretty much with the dollar. And then the euro has been rallying. And so the dollar has been falling. The Dixie index, which is what's shown here, has a big weight in the euro. And it's at a local high now at about 105 as of a few earlier today. So that's been moving up. This is not positive for foreign currency investing. It's not positive for emerging markets in particular. Let's take a look at that. This is the emerging market, JP Morgan Emerging Market Currency Index versus the dollar. And it's just really weak. The Emerging Market Currency Index is basically on the lows. And it's come down a fair amount from 70 6 years ago and 58 2 years ago down to 47. So it just continues to fall in a fairly consistent pace, at a fairly consistent pace. And for me, I wouldn't really get aggressive on emerging markets in the fixed income market unless this thing started to reverse and get above the 200-day moving average, which is not terribly far away. So if it does start to rally, it can rally a long way. So I wouldn't try to catch a falling knife here. Let's go to the recession indicators. Here's the leading economic indicators, which have been full-on recessionary for so long. It's been a couple of years almost, at least a year, that they've been at -7, -8 type of level. And both the 12-month number and the 6-month number annualized are right there on top of each other in the -7.5 to 7.8 category. So one thing is we haven't had a recession. So a lot of these recession indicators, and particularly the monetary M2 indicators, have led economists, particularly monetary economists, to overstate the recession. A lot of the real monetarists in their economic research were predicting 1 year ago that we'd be in a recession in the first quarter of 2023, which obviously did not happen. All these indicators are skewed, obviously, by the craziness of the government money and the shutdown and the reopening. So we had economic activity moved all over the place. So we'll see if the leading indicators can start to be a little bit less recessionary. But for now, they're clearly in a recessionary signal, as is the yield curve. We're just using the 2s, 10s here. 2-year to 10-year is now 73, 74 basis points inverted. It's been inverted for a while. When the curve first goes inverted below the zero line, it puts you on warning, but it's not a short-term warning like a recession is going to start in weeks or a couple of months. It usually has to stay inverted for a while. Well, we've kind of done that now. We've been inverted long enough, and what's really creates the signal is when you go from an inverted position that's been in place for months or a couple, 3, 4 quarters, and then suddenly it de-inverts and goes back above zero. You'll notice that the red shaded areas, as always, are recessions, and you'll notice that the red line goes below zero and then back above zero, and that's pretty much when you get above zero that you get the leading edge of the recession. And that hasn't happened yet, hasn't gone above zero. So we'll see if the economy weakens with this tax stuff that I referenced, and with the Fed, the cumulative impact of the Fed tightening, which of course we all know has long and variable lags, but it's been long now. They've been tightening for a year and a half, and they've tightened, as we saw in the second slide, much more than they have in the past, basically 30, 40 years. So the effect should be somewhat significant. So I do expect that we're going to see a recession in the first half of 2024. I don't think, clearly, now that we're getting near the last quarter of 2023, it's not likely, given where we stand now with economic momentum, that we're going to get a recession before year end. But I do think there'll be one in the second quarter. Now, what's interesting is when we have recessions, we typically think of bond yields falling, and I suspect bond yields will fall in the Treasury market if we get a recession. But I have this suspicion that the government response will be so wild, as it's been more wild in every recession going back for decades now, that it could be inflationary. It could be an inflationary recession. We could see such a monetary response and perhaps quantitative easing and the zero interest rates and all that stuff that they've done now with some predictability that could lead to inflation, a monetary inflation, even though we're in a recession. So the real stagflation might be coming, not what we had a year ago in 2022 when people thought the economy was weak and inflation was really high, but inflation could definitely go back up. We might have an unusual circumstance where after a bond rally, which I would expect at the onset of a recession, we might see something that people aren't used to, and that is rising interest rates in sort of a stagflationary type of recession, an inflationary recession, thanks to government policy. This indicator that's on the screen now is the unemployment rate versus its 12-month moving average, which is the red dotted line. And we have the recession signal now. I've been talking about this for a while, that when this line crosses over, definitively, it usually coincides with an upcoming recession. There's false positives on that crossover, but once it really crosses over, once you get 50 basis point increase in the unemployment rate, historically, you've always had a recession. We've already had it go up by 40 basis points. So we're not very far away from that going into a true recessionary signal, which would be an unemployment rate of about 4%. We're only 20 basis points away. This is the absolute definitive unemployment recession indicator. That's using the 36-month moving average, and there are no false signals here. Basically, when you get the crossover from the real-time data to its 36-month, 3-year moving average, it's a recession, and it's pretty good at timing it. There's 3 examples on here, and all 3 of them work basically perfectly. This should cross over in the first quarter of 2024 based upon some sensible forecasts of what might be coming in the months ahead based upon the trends that have been in place for the past couple of years, and it suggests that this could cross over. That would be a full-on recessionary signal. I expect that could happen in the first half of next year. So the timing is kind of lining up that way. So here's consumer credit, which, if you look at the recessionary periods, the red shaded areas, when you have a very high flying green shaded area and it starts to collapse, it usually means that the consumer has borrowed too much money, has too much on their credit card, conditions get tighter, and suddenly they start reducing their credit card debt, and that helps to add to the recession. This one, most recent viewpoint, really looked like it a month ago. It looked like it was a classic recession starting immediately, but then we had this rebound. So now it's back up into pretty high borrowing territory. Maybe that's just because people need to borrow money to get by as their savings have been curtailed. I think this is going to be really interesting to see what the next reading on this is, because if it stays high, it probably is further corroboration there's no recession in the months ahead. But if it tanks down below 0, then that means that something's going wrong with the consumer's wherewithal, or else their attitudes about the economy. This is what some attitudes are from the conference board. Consumers saying jobs are plentiful, minus those saying jobs are hard to get. So it's in a very good level still, but it has that look of a pre-recessionary movement. We see when the green shaded area starts to shrink, it generally starts to shrink and keeps shrinking. The momentum tends to sustain, and then that causes a recession. We're not close enough yet to make that determination, but the shape of the green shaded area looks pretty recession is coming type of a signal. And here's C&I lending standards to small firms overlaid against GDP with a 2-quarter lag. And so we see lending standards, the red line, when they tighten, it tends to mean that when they tighten sufficiently, GDP goes into recession about 2 quarters later. So that has that look right now. So if this follows the pattern, then we would expect the blue line, which is plotted inversely, that's the GDP, that would go up, which means GDP would go to 0 and below, again, expecting that in the first half of next year. So here's a couple charts on global conditions. And away from the United States, conditions are even worse in most places. Germany is just terrible right now. Japan's doing a little bit better, thanks to a little bit of inflation, but Europe broadly not in very good shape. And if we look at the combined twos, tens global government yield curve. So this is all governments. What we see is the average is inverted, and it's inverted for the first time ever in the history of this index. So it looks like the economic problems will be global. Also, this is just an interesting fact, fun fact to know and tell. China has had a huge increase in youth unemployment. Ages 16 to 24 in 2021, it was at 12%, and it went up to 21.3% in June. And that was sufficiently alarming that China has stopped reporting this. It's kind of like some of these South American countries that stop reporting their inflation because they don't want to admit how bad it is. Here, they don't want to admit how bad the unemployment data is. So China really looks like they're not going to be able to sustain above 5% GDP growth to me. They've had it for so long, and they seem to be really struggling right now to maintain that. And we can see a tie into that perhaps with Korean exports, which are interesting broadly because it's such a heavily export-driven economy. And so their exports tend to be a big global indicator. And obviously their exports are shrinking. We see that year over year, they're down 8%. From a relatively high level, because the gains were so big in 2021 and 2022, but they are falling at the present moment. So let's go to love, and we'll talk about areas of the market that are worth loving and some that are not worth loving. And I've got a graphic here. That's a Robert Indiana statue, the famous love statue, his most famous artwork. And this is installed at the opening of the entrance from Elmwood Avenue to the Buffalo AKG Art Museum, which just opened with the new building. And this is not the new building. This is the sculpture that's covering the old 1962 sculpture courtyard. But if you're ever around near the Buffalo area, I highly, highly recommend a visit to what is now one of the world's greatest art museums in both collection and physical plant. Let's look at what I don't love. It's hard to love equities when the risk premium is the lowest in 17 years by a lot. So look at where the risk premium was, say in 2021, it was at about 3.5, and now it's at 0.6. So a lot of price action has been due to the PE ratio. Certainly earnings haven't done much of anything this year. There's expectations that they'll go up next year by about 11%. I'm going to take the under because I think the economy will not be as robust with my sort of anticipation of recession in the first half. So we're not priced for a recession here at all with this equity risk premium. And let's compare it to bonds globally now. This is just global yields, this bond yield and the equity yield. And see where we were back in the first part of 2021. You see that the stock yield, the blue line, was quite a bit higher by more than a percentage point than the red line, which is the global aggregate yield to worst. But look how that has changed. You now have double the yield on the global aggregate than you do on the MSCI All World Index. And this is a very extreme level. You'll notice that this is very similar to the setup prior to the global financial crisis in terms of the relationship between the yield on stocks and bonds. So take that as you will, but it is an interesting point to pay attention to. Here's the 10-year Treasury yield. And a lot of people think that we've gone up a lot in yield in the past year, but we haven't. In fact, the yield is exactly the same today as it was about a year ago on the 10-year Treasury yield. It went up quite a lot in the late summer of 2022, and then reversed, and we had a nice little rally there of about 100 basis points, and then we went right back up, and we've exactly matched that top level. So is it a double top? I think one of the reasons to think maybe it is look at the momentum divergence down at the bottom panel. So we like the long-term Treasury bond market for a short-term trade, particularly going into a recession. We do have a duration in the total return bond fund that's about 6.25 years, which is longer than we've been since we started DoubleLine, although we've been at this level now for several weeks or a couple of months. And we did our last buying of the 10-year at 4.25. So we're pretty much at the same level. So no harm, no foul, but we want to be in a position to have a profit in case parts of the credit portfolio might have some deterioration with more economic weakness that could occur. We like this risk barbell concept that we used 10 years ago, and we used it until about 2016 when it wasn't available anymore because treasury yields couldn't fall once you were down at 0 on the 2-year. And inside of 1% on governments broadly, the idea that you would have a rally, even if there was a recession, didn't make plausible sense. But now you can. You can easily see the 10-year go back down to 250, sort of in a Pavlovian response to recession. That might be a good sale at that point. We'll stay tuned and see how that develops. Here's the copper-gold ratio, which has just not worked at all for the past year. It worked really well in anticipating the up move in 2021, where you saw the copper-gold ratio was just very elevated versus what the 10-year was, the red line. But now we see the opposite is happening. So maybe this is indicating on a delayed basis, just like it was ultimately accurate in 2021, maybe it'll be accurate on the downside in yields going ahead. Now, if you want to be a bond bear for the long term, and I think there's plausible reasons to be a bear long term, this doesn't work for the next 6 to 12 months, but this works long term. When I say long term, these are 7-year moving averages. So let's take a look at the core PCE, 7-year moving average, and the 10-year U.S. Treasury yield. You'll notice that it's almost always the yield is higher than the 7-year moving average of the core PCE. That was the case all the way from 1967 until, 2012, very briefly. We had a little red area, but it was really true broadly from 1967 until 2020. So what are we talking about here? 53 years? So, and also I want to point out that from 1980 to about, let's say broadly speaking, 2016, the line was declining. The 7-year moving average line, that's changed. So we had a 40-year bull market that was persistent because we were always declining on this line, but that line isn't declining anymore, and it's going up. But at least the yield is above the line now. Where we were in 2020 was just nonsensical. The line was going up, suggesting broadly secular rising bond yields, and yet the yield was at 0. So this is kind of a long-term bearish indication for the 10-year Treasury yield. Here's the 7-year moving average of GDP. So we got nominal GDP, 7-year moving average, and then we've got the 10-year Treasury yield. And it's kind of the same picture. You'll notice from 1980, here only went till the year 2000, but for 20 years, we had the 7-year moving average of nominal GDP decline. In fact, it continued to decline all the way into 2014, but yields got ahead of themselves. They were very, very suppressed because of the suppression of yields by the Federal Reserve. But again, this line is now moving up. Nominal GDP is moving up. And so we would expect that this would drag 10-year Treasury yields over the long-term secular basis higher. So that's something to keep in mind. I don't think I've shown this in a few years, but it's something we used to use routinely, and I'll make sure that we catch up on it at least once a year, maybe a couple times a year in these webcasts. Here's the 30-year U.S. Treasury yield. It was in a very contained channel with a few overshoots, both above and below the green parallel lines. But this goes from 1990 into 2020. So here's another 30-year downtrend that's been completely reversed. It really looks like this has bottomed. It's hard to believe that we got to 70 basis points on a 30-year Treasury bond. That was in the teeth of the lockdown and people's deflationary fears, but we've just skyrocketed back up. So we're up by almost 400 basis points, which means that from the peak price of the long bond to where we are today, there's been a drawdown of about 50%. So pity the poor people that bought the 30-year Treasury bond at 70 basis points and thinking that they were in something safe because it's had an equity-like drawdown, and it really hasn't. As you can see, the yield is very near its peak here. So it really has still fully suffering a 50% drawdown. At least that means it can go up in price, which was not the case when you were beginning at 70 basis points. Let's look at some valuations, some spreads in markets. Here's the investment grade corporate bond market on the left-hand panel. It's been pretty well contained. It got out to about 160 basis points last year, but then started to settle in as risk markets broadly found their footing. And we're down at about 120, which is about retracing half of the widening from the lockdown to the high-end spread last year. So it's not really rich, but it's certainly not that cheap either. Then we see what's really less cheap, I think, is high yield, where high yield got out to almost 600 basis point spread last year, and now it's down to 374. And it's rare indeed that you get inside of 300 basis points on high yield. So I'm sure there are some selected opportunities on a rifle shot basis in the high yield credit market, but as a broad theme, not really that interested in it relative to what we can find in structured credit, which has much better spreads, and we'll see that soon. This is CMBS. This has been the most challenged sector in the entire credit market. This is JP Morgan's non-agency CMBS on the run spread. And we say that it's just hovering up there. It's been the same since March on the triple B minuses. We're at 893 basis points, which is a lot of yield. The reason that spread is so wide is the market is anticipating some defaults, I think correctly. It's going to be very sector specific. You've got totally different dynamics in office in urban areas versus, say, leisure and hospitality, multifamily, et cetera. So it's a very much of a bond pickers market in CMBS, and we've been doing a lot of activity there. We see that the other sectors, the single A, double A, and triple A, those spreads have been pretty calm since March. In fact, they've come in. The single A's remain elevated, probably be a few losses there. But when you get to double A and triple A, I really think it's almost impossible to get losses if you're doing any kind of decent credit underwriting. And so we have spreads of 141 for the triple A's. That's obviously much wider than investment grade corporate bonds, which don't have that type of a rating, which are at 121 on average. And then you see the double A's, which are probably a better comparison to the investment grade corporate market. And those spreads are 258, and we would not anticipate losses there. So that part of the capital structure looks very attractive. So that's a sector to love. And then we have emerging markets. I'm just adding this for completeness, really. And what we see here is the spreads are 421. So they're higher than high yield spreads, but the dollar remains strong. The EM currency remains weak. And that's part of the reason, I think, why this hasn't recovered quite as much. And you'll notice recently with the dollar strengthening in recent weeks, we see the EM spread widening yet again. So it's very dollar dependent. And we would want to see the EM currency index rally above its 200-day moving average versus the dollar. That has not happened yet. Let's take a look at the agency mortgage market. This is really fascinating, something that nobody's experienced before, even somebody who's been at this as long as I have. The blue line is the effective mortgage rate on all the debt outstanding. So that's debt that was taken out, mortgages taken out last year, 5 years ago, et cetera, whatever's still there, and it's at 3.6. And the new issue mortgage rate, there's different numbers. There's bank rate, and then there's a Freddie Mac number. The Freddie Mac number is 7.1. This means that the average mortgage is 360 basis points out of the money, which means rates could fall 200 basis points, and a very large sector of the mortgage market would still not be close to being refinanceable. So you can see on the bottom panel what the spread difference, what the difference is between the red line and the blue line, and it's never been anything close to this. This is why housing has so little activity in existing home sales. Nobody wants to get rid of their mortgage. Their mortgage is one of the best things they have. If you've got a 3% mortgage, if you could sell that to somebody, they could probably pay about 130 for it because you're so much farther below the actual new issue mortgage rate that there's value in that. So we see some of the lowest housing activity on existing home sales of all time. Of course, the home builders are starting to step in with new home sales, but those take a little while to build. So that's been an odd sector of the economy for sure. Here's the index yield and yield to worst and the average price and average coupon. So at the top, we have the agency mortgage yield to worst, and it's at 515. It's higher than it's been in a number of years. And then we see down at the bottom, the price of the index is at 86.61, and the coupon is at 3, having just risen from the high 2s. So obviously mortgages don't have any refinancing risk. There's just no risk at all here. There's no negative convexity. I'll show that now. It's actually a positive convexity in the mortgage market for the first time in the history of the market. It happened also last year. But this means that the risk of the mortgage market is the lowest ever. In simplistic terms, it means versus treasuries, the risk of the agency market is less than ever. And yet the spread is among the highest in recent years. This is the option adjusted spread. So it takes into account the optionality, which is so little that it doesn't create negative convexity. But we say it's one of the higher spreads. And so you have one of the best rewards and one of the least risks. So on a risk-adjusted basis, this sector is incredibly cheap. In fact, its spread is sufficiently wide that it's really, they look sort of cheap to even the non-guaranteed mortgages, which have a little bit higher yield. But the extra yield one gets from the non-guaranteed mortgages is at a low level versus the agency guaranteed mortgages. But that might still be justified because there's no risk in the non-agency residential mortgage market. Everybody's got a gain. Everybody that bought their houses have gains, and they're not going to default when they have big gains. So the risk is just as low as it was, I would say, back in the good old days, like 1995 or something like that. Here's a scatter of time periods we're mapping the mortgage spread to the 5-year, 10-year Treasury on the left-hand axis, and on the x-axis, it's the Bloomberg corporate investment grade OAS. And so when you're in the upper left, it means mortgages are cheap. When you're down in the lower right, it would mean that corporates are cheap. And you can see the yellow diamond. It's obvious that mortgages are cheap on a valuation basis versus the investment grade corporate bond market. Now I'm going to turn the presentation over to Andrew. He'll go through some facts about the portfolio, and I'll be back to answer a few questions from the queue. Andrew, can you take it away?
I'll start by talking about some of the fundamentals on the portfolio, driving our portfolio decision-making process, and then conclude on just positioning where we are right now. So first off, let's just start by looking at the U.S. consumer. They certainly have been resilient, but we have been seeing cracks form for quite a few months now. On the left-hand side, we do see delinquency rates for various credit card issuers, and it's very clear that the borrowers are increasingly paying late or even missing payments altogether. Now, credit card companies, they target different cohorts of the population. On the left chart, the aqua blue line at the bottom of the page, or the chart, represents American Express. And American Express typically issue cards to the highest credit quality borrowers out there. And then the gold line, in comparison, at the top of the page, is Bread Financial. And that is a tech-based financial company who offers credit cards to a much wider audience. It is worth noting both cohorts and pretty much everyone in between are seeing delinquency rates return to pre-COVID levels. Now, the more concerning issue is that delinquencies are rising in an environment where we are seeing increasing defaults. So on the right-hand side, we do see default rates for those same issuers. And you can see a bit of a dichotomy here. Lower credit quality borrowers are defaulting at an accelerated pace versus higher quality borrowers. Filling in a little bit more on this consumer picture, here we see recovery rates, and they are falling across credit card ABS transactions, and really pretty sharply across all cohorts, regardless of the credit quality. Now, against the backdrop of rising delinquencies and defaults, if this does persist, it does certainly seem that the consumer is weakening. Okay, the first time I saw this chart, I thought it was a bit of an oxymoron. So maybe let me spend 30 seconds here just talking about it. Here, we're looking at a charge-off rates for US and Canadian credit cards versus the monthly payment rate. And the monthly payment rate is the percentage of a borrower's monthly balance that they're paying off at the end of the month. The gold line is showing that the charge-off rates for private label credit cards is increasing at a very rapid pace. And then broader credit card issuers, and this is the other two blue lines, aqua and the darker blue, both in the United States and Canada, are not writing off losses just yet. The teal line, and this is where the contradiction kind of comes in, is showing that the monthly payoff is essentially 40% of the balance of the outstanding balance for these borrowers. Now, that does seem not to jive with kind of what's going on with the private label space. Now, let me just fill in the gaps here. The 40% corresponds to the payoff rate for the largest credit card issuers, and these tend to be the higher quality borrowers. Private label cards typically correspond to lower quality borrowers. So again, this reinforces the theme that financial stress is more pronounced at the lower or with the lower credit quality borrowers currently. So despite some of the noise about deteriorating market fundamentals, and this is very similar to the CMBS slide that Jeffrey was talking about in spreads, we've seen a pronounced recovery in asset values from 2022 levels. The price recovery has disproportionately benefited higher quality assets. And here we have a time series of ABS spreads, or asset-backed security spreads, segmented by credit quality. And you can see the blue line, and this represents the AA rated assets, so very highly rated, is approaching pre-COVID levels. So we are seeing a pretty good recovery there. The gray line represents the lowest quality assets, and this continues to see spreads remain at elevated levels. We've spoken about this in previous webcasts. We did take an active approach during the second half of last year, migrating into higher quality assets, and this certainly has been a value add to the portfolio given data such as this. Okay, issues with commercial real estate, continue to grab headlines. On this chart, we see the rolling 6-month average loan payoff rate for office buildings. As recently as 2021, payoff rates at maturity were 93%. Today, they've fallen into the high 60% range. So that's a pretty marked drop off. Now, the good news is that we don't expect to see a large number of office loans come due for the remainder of the year. But maturities do pick up steadily into 2024 and 2025. Without a robust CMBS new issue market, and issuance volume is down in CMBS this year, payoff rates are likely to decline further, and this will put additional pressure on this segment of the market. Okay. Looking at broader borrower behavior, mortgages continue to show strength, and this is evidenced by the low delinquency rate with the red line, especially when you compare it to the purple and blue lines, which clearly show some fractures within the consumer space. Student loans, and this is the black line I'm referring to, repayments on federally funded student loans will be reinstituted soon. It's really October of this year. So we are firmly of the belief that artificially low delinquencies seen in student loans are going to mean reverse. So you will see marked increase in delinquencies in student loans. So that is our positioning here. Okay. Within the universe of fixed income, one of the areas that we're seeing the most value is in the mortgage market. We've been expressing our views in tactical ways. A few slides earlier, Jeffrey was speaking about the favorable convexity profile that's achievable in the space currently. But I want to take a step further and illustrate how you can attain more value through an actively managed portfolio versus a passive one. So there are 2 lines on this page that illustrate the convexity of 2 separate indices. The gray line is the broader mortgage market, and the blue line is the CMO Z tranche index. And what that is it's an index of longer duration mortgage-backed securities. For any investment, mortgage related or not, you really want to have the investment that offers the most positive optionality. Now, I've come across many investors in the access to the mortgage-backed securities market via passive funds or ETFs, and what they're getting is the gray line. Is it attractive? Sure it is. But are there better options? Absolutely. For DBLTX, well, we've been active in identifying the best opportunities in the space. And in our effort to extend portfolio duration, we've also identified longer duration mortgages that are able to provide both duration exposure, but also some of the best convexity we've seen during our entire careers. This can be evidenced by the difference between the blue line and the gray line. Clearly, the blue line is showing significantly better positive convexity than that of the average market, which is the gray line. And this certainly is a case where active management is important in identifying some of the best opportunities within the mortgage market. Okay, next we'll just talk about positioning and the makeup of the portfolio. A new slide here that we'll talk about. The blue line is charting the treasury yields at different tenors. And we're comparing that to components that make up the total return bond fund, and that's being represented by the red diamonds. I like to think of the architecture, and Jeffrey was talking about the barbell architecture. I like to think of it as a scale. The fund architecture is a scale where on one side of the scale, you have credit risk, and then on the other side of the scale is where we express our views on interest rates. Now, on this chart here, everything to the left of the 5-year point of the curve is our credit exposure, and that's going to be the non-agency MBS, asset-backed securities, CLOs, and non-agency CMBS. And these are positioned at the front end of an inverted treasury yield curve, where you're able to attain very attractive yields. Some of these yields are astronomical, and I mean, especially if you kind of factor in how high quality some of these assets are. To the right of the 5-year part of the curve, we're looking for assets that not only derive value from yield, but also really looking for added positive optionality into the portfolio. And certainly we're able to do that with longer duration mortgages at this time. They are uniquely positioned to offer that to us now. There are many investors out there who are compelled just to sit in treasuries, and with yields where they are, certainly can't blame them. But looking at some of these opportunities that are available and the ones that we're executing on, I'd really urge investors to take a hard look and see if there are better options that would fit your long-term goals. Okay, we'll dovetail back and talk about the commercial real estate market. We did put together a couple slides here to give our listeners a bit more clarity on how we've invested in this space. On the left, we see a pie chart, and this represents the entire fund. And non-government guaranteed commercial real estate accounts for approximately 7% of the entire portfolio. Only 1.7% are in office. On the right, we show the investment types and the amount of protection afforded to these positions. And you can see that regardless of the instrument type, there's significantly more protection in the form of credit enhancement and LTV when you compare it to serious delinquency. So despite all this news, we still own very, very well-protected positions. And I would say that this is not just a resiliency story here. We're able to find many discount opportunities in the space. And when you factor in losses, even when you do factor in these losses, we see yields in the high single digit to double digit range. So again, very attractive opportunities out there if you can do the work and you know where to look. A little bit more granular here, we break out each CMBS instrument to show various metrics. I won't go through all the numbers here, but on the top table, you can see credit enhancement and LTVs are providing substantial protection. Again, this is redundant, but again, our investments are very well protected. And then on the bottom table, what it shows is that these positions are also very well diversified. We do have exposure to multifamily, which is very strong, industrials that are very strong, and even retail and lodging that has produced very good numbers. And office is certainly in there, but again, we are very well protected even against the stresses seen in that space. Just a few more slides for me, and then I'll hand it back to Jeffrey to answer some of the questions that have been coming in. Looking at some portfolio statistics here, we did mention positive convexity, and that's reflected with the discount average dollar price of the assets in the portfolio. Duration, right on par with the index. And the fund is seeing almost 150 basis point yield advantage versus the index. Hopefully, the earlier slide where I was discussing where we're positioned can depict how we're able to achieve that excess yield, but very attractive at 150 basis points over on a very high quality portfolio. In terms of duration over time, the fund is positioned at the top end of its historical duration range. This is very much deliberate. And with the mortgage market offering these types of opportunities, we can extend duration and also improve the overall convexity profile of the fund at the same time. So very happy with our positioning here. Looking at the fund composition, we've taken an overweight to government guaranteed assets. These would be the agency MBS, CMBS, and treasury positions. Credit accounts for only 40% of the fund at this time. And the credit that we own, again, I would mention very high quality. This is a move that we made in the middle of last year, which has certainly been paying off. And then finally, looking at the credit portion of the portfolio a little deeper, our average credit enhancement or the ability to absorb losses is reflected by the blue bars here, continues to be significantly robust versus any serious delinquencies, and that's shown in red. For those areas where the margins are looking a little bit tighter, and I'd be referring to the legacy non-agency RMBS or mortgage-backed securities on the far left here, you do need to factor in the discount dollar price. That would give the blue bar a very big boost. If we did that, we just show the absolute credit enhancement here, but I just want to make that point out. We do see the credit portion of the portfolio is very resilient, even in very challenging economic environments. And the migration into yieldy but high-quality assets does leave us sleeping well at night as well. So with that, I'll hand it back to Jeffrey here, but thank you very much for your time.
Thank you, Andrew. Thank you, Andrew. I'm going to go through half a dozen questions here in the interest of time. One is, do you think the inverted yield curve is still predicting a recession? Yes, I do. Is the market's PE expansion accurately predicting large earnings increases or just irrational exuberance? I think there could be earnings increases next year. I think they're overstated. So I think we do have very high bullish sentiment, very different from where we were in March. And I think the market is pretty overvalued. Obviously, a lot of us know that if you take out 7 or 8 stocks in the S&P 500, the return of all the rest, the S&P 492 or whatever, is up about 2% through the other day on a year-to-date basis. So not very different from parts of the bond market, actually. Somebody says, I'm invested in the total return fund. What strategies do you anticipate using if 10-year yields go up next year? Well, if we anticipate yields are going up next year, we would reduce the duration of the fund. We own treasuries and long-term guaranteed mortgage-backed securities. If we get a rally that we anticipate, that could be the last one in a while. If we go into the type of recession that I am postulating, you would want to reduce duration at that time. Someone says, what dates will the Federal Reserve decrease rates, stop QE, and distribute funds to the government again? I would anticipate that movement would happen in the second quarter to the middle of next year. This is kind of, I don't know if this is facetious, but what will be the effect on the stock and bond markets when, it doesn't say if, it says when, China seizes Taiwan? Obviously, the actions leading up to such a movement would be highly uncertain, and there would be a lot of fear. I think you would have flight to quality in investments, at least initially in that. And then depending upon what our response is, you might want to buy defense stocks. We'll have to see how that develops. What are the similarities and differences to today's housing mortgage markets, comparing it to 2006 to 2008? It couldn't be more different. The risk in 2006 was absurdly high. Home prices were very high, and people were buying them with zero interest payment mortgages and stuff. None of that exists anymore. Most zip codes in America have huge gains in prices relative to their mortgages. And he says, will there be a 5-year decline in housing prices? There's no decline in housing prices, so let alone a 5-year one. Housing prices had a small dip, but they're basically right back to their highs again, thanks to the total lack of supply and transactions. So you would need more new homes to come online, or else you would need unemployment to go up to start to see home price declines. Do you like the CLO market, especially the AAA tranches? The AAAs are okay. I mean, it's better than cash because you get a spread and you have a floating rate asset, but the prices are very much close to par again. So we have some AAA CLOs in the Total Return Bond Fund. I think Andrew alluded to that. You saw the slide, the prices are 99 handle. So they certainly are not distressed in any way, but there's also really no risk there. And so does one scale out of money markets, i.e. when Federal Reserve first cuts rates? Yeah, I mean, when they cut rates, it's probably a little late to get out of money markets because the long end would probably rally in anticipation of that. But right now, the mantra for a lot of investors is T-bill and chill. And while that's simplistic and rhymes in a clever way, that's not what I recommend. The 6-month T-bill is the highest yielding thing. It's about 5.55%. But we have, there's ways of getting like this, the CLO market, you get a spread on top of that. So you're getting yields that are up, at around 6.5% to 7%. You can find that in other areas of 2-year securities with spreads on them. So that leads me to the next question. Well, there's 2 more questions. Someone says, a few years back, you recommended an allocation of like 25 stocks, 25 cash, 25 hard assets, 25 bonds. Would you recommend the same today? Pretty much, I would. I would not recommend U.S. equities. I would own other foreign equities than U.S. equities. T-bills cash, that's T-bill and chill. I think you might be better off in the CLO fund, or you might be better off in our ETF DCMB. And that leads me to the question on that. It says, Jeffrey, I'm comparing DBLTX with the new ETFs, DCMB and DMBS. I own all 3, but would like to allocate additional funds. Based on your assessment of the balance of risk, do you think now a good time to move to a higher weighted portfolio of non-agency versus agency for both CMB and MBS, or stay more risk off? Well, I'm a huge investor in DBLTX. It's by far my biggest holding. I'm well into 9 figures of my own personal money in DBLTX, and I'm completely comfortable there. When it comes to DCMB, it's all AAA, and it yields about 7.5% and has a 1-year life. So forget about T-bill and chill. The DCMB is way better than a money market fund. You have no risk to speak of, a 1-year life, which is very similar to a money market fund, and a yield of about 7.5. And we're not going to have any losses there because of the AAA positions as we're structured right now. So that's just a fantastic income vehicle, and probably the best Sherman ratio, yield versus likely volatility, of just about anything in the public markets. And DMBS, I own DBLTX personally instead. There's nothing wrong with DMBS. I'm just completely comfortable with my mix of assets in DBLTX. So that's what I have today. We're up to an hour and 5 minutes. That's good. Tough Bills loss. Josh Allen looking like a rookie. I don't know what's going on there. He's in season 6, and he still plays like a rookie sometimes. So hopefully this week we'll do a little bit better. So with that, we'll have another Total Return webcast in December. That'll wrap up the webcast for 2023. We continue to work hard, and we're invested with you side by side with a lot of our own personal money. So with that, thank you for your interest in DoubleLine, and goodbye for now.